Hi and welcome to Trade of the Week. Now, I reckon that overall the trade of the week must have been to sell sterling yen, but that was pretty well covered in yesterday's article. And anyway, I missed the trade by waiting for a pullback that never was. This week's featured trade, a long bet on EuroDollar, wasn't the biggest winner, but it does add another trading weapon to our armoury. The EuroDollar has been stuck in a 300 pip trading range for much of the autumn. The upside was capped by rock solid resistance at 150, but significantly, the lower points were getting higher, suggesting that pressure was building for a breakout to the upside. This Monday, with the dollar once again under pressure and stronger European industrial confidence numbers, the euro came within 2 pips of the big figure before profit taking knocked the froth off. I felt the move above 150 was getting closer and fancied looking for a setup to go long. Recently I've been trying to improve my entry points, looking at trading the pullback to get a better risk-reward ratio than from trading shorter-term momentum. One of the strategies I've been looking at is the 50% fib retracement, which is used successfully by a couple of traders I know. I already focus on Fibonacci levels over longer time frames, but I'm still learning to use them for day trading. One of the advantages of this strategy is that trades can be set up in advance. So for this trade, I placed a limit orders to go long of £5 at 149.05, just below the 50% pullback of the last rally from Friday's low to Monday's high. An alternative method is simply to measure 50% of the previous day's move. I placed my stop loss order at 148.75, far enough below the big figure to avoid the stop loss hunters, but close enough to limit my losses if I was wrong. On a £5 bet size, my risk was a very manageable £150. I still prefer to lock in an early gain and roll the dice on the balance with some money in my pocket. So I decided I would sell £2 at 149.35 and run the balance with my stop loss at break even. I'm still working on a more consistent exit strategy, but for now I'll rely on a selection box of candle patterns, oscillators and moving averages. My order was filled before 7:30 on Tuesday morning, but I was soon 15 pips in the red. However, the market recovered and delivered my 30 pips on £2. I'll show you where that was. With my stop loss at break even, I watched the price push higher throughout the morning. Now, I'd love to claim that I followed the move through to the following day's high of 151.45, but I didn't. And that's why I need to think long and hard about a more adventurous exit policy. My trade ended around Tuesday lunchtime, when a red candle said goodbye to the upper Bollinger Band and traded lower than the previous 30-minute doji. I sold my remaining £3 stake at 149.70. So, I made 30 pips on £2 and 65 pips on £3 for a total profit of 255. Not too exciting in the end, but money in the bank for a small level of risk. However, there are lessons to be learned. The 50% Fibonacci pullback worked well, and I'll definitely use that again. I made money. But check out the possible profit if a different stop loss strategy had kept me in the trade for the following day's break above 150. After all, that was the original reason for the trade. I'm still looking for the right solution to my exit strategy. The candle patterns always like to take me out too early. But in this case, using a parabolic curve or a trailing 50 pip stop loss would have resulted in even lower profits. So answers on a postcard please. Have a good weekend.